Welcome to TMS Insights. It's a bit of a different insight today, Ben and Jeremy again, but from each respective homes rather than the office. It's right in the middle of July. It's Bastille Day, and we're hard at work and giving people a bit of an update. So lockdown, tough for a lot of people, I suppose. Ben, you're going well in the family?
Happy Bastille Day, Jeremy. Life is a juggle at the moment. Having a 5 and a 7-year-old homeschooling and working is not the easiest sort of setup, but let's hope it's only a few more weeks.
Yeah, good stuff. And it's a big hello to all our clients and friends out there, and hoping that everybody in your families are going well. But the purpose of the update today is about the markets. And Ben, it's been a phenomenal time. The end of the financial year was a joyous time, and it's continued into July.
Yeah, and I think in more recent times, Jeremy, particularly in Australia, fueled by one of the most incredible M&A booms that we have seen in some time. 07, sort of 06, 07, we saw something, but I don't know if it felt quite like this. I don't know what you think, but that we've got one or two deals coming through virtually every day now. We've got one breaking at the moment, which is interesting. And, we've obviously had a few of our companies tied up in this. So, it's really interesting.
No, look, it is. And you like that's, I think, one of the things. While people are clearly being disrupted in their ordinary activities, the markets are about as busy as we can imagine them, both with absolute level and with, the amount of activity. So businesses are not wasting time. If they want to grow by acquisition, they're making the bid. So the one you're talking about is Spark Infrastructure, which, we looked at in a trading halt. That was rumoured in the press yesterday. And it comes on the back of Sydney Airport, which we found on July 1. Big surprise, there was the takeover deal. A big one, industry funds, and I believe their board's meeting at the moment, Ben.
Yeah, it's in hindsight, not surprising, but it is that the size of it is incredible. This is a close to $30 billion enterprise value asset, and it will actually be the largest takeover in Australian corporate history if it does go through. I guess we probably both feel a bit in two minds about this, because it's always nice to get a good price in the short term, and it looks like Spark's potentially about to go the same way. It also means much longer term, when we're trying to build portfolios for clients, it reduces our options, in terms of the quality of assets that we can invest in. And, once Sydney Airport if it does depart from the boards, it's never going to come back, and there's only 3 or 4 airports that actually trade on global exchanges that you have the option to invest in. They're all locked up by sovereign and pension funds. And, it's sort of, I can see the attraction, but I can also sort of in some ways reluctant to see it go.
Yeah, I think that's well expressed, because we know that we see a jump in the price and we make money for clients at that short-term thing, but they're long-duration assets, and they are perfect, like super funds as a result. And it's that reason why that's industry super is making that mega bid for Sydney Airport. But they've got a few hoops to jump through, and price will be one of them, $8.25, a good price, but we don't think it's a knockout price, and they might have to raise that. So it is trading below that figure at the moment. There's a bit to run there, but it's clear, with an interest rate environment like we've got and will persist, these assets are attractive. So, it's welcome to have the attention, but it does, and it's well said by you, Ben, how it creates that complication. It might end up we have to look offshore for similar infrastructure assets.
I think that could be well right. I mean, Rome Airport is publicly traded, and there's one I think in Copenhagen, which is a collection of interests in various European airports. But the other point I just want to make on the back of this is it just highlights how inefficient markets can be. Sydney Airport has a concession on the asset for the next 76 years, and the market was really pricing it as if these current conditions that we're seeing it were almost permanent, in some ways, and or maybe not permanent, but maybe much longer tailed than they're actually going to turn out to be. And one thing I would say to clients is it's worth bearing in mind, particularly during these lockdown sort of periods where you can get emotion and, concern over quality assets, very long term. Just because, say, an office block or a toll road or something similar isn't being used at its normal rate, you don't want to get too short-term focused on that. And the professional investors will model this over decades rather than months. So there's always opportunities.
If you as an investor sitting at home think, oh, there's a lockdown started today, let's sell everything exposed to the lockdown, you're so far behind the game, aren't you?
Yeah, completely. And
it comes the other way, right?
You should be thinking about it the other way around, because look, we should probably have a quick chat about the lockdown, because it's not fun going through it. But I really, my view, and everyone's got a view on vaccines and all and lockdowns and how we treat COVID. But I think we would be in agreement. Our house view is that this is actually a good thing, in that this short-term pain that we're experiencing at the moment has got governments, the population, state governments all on the same path that we have to get vaccinated much more rapidly than we would have been if we hadn't gone into this lockdown. We've now seen some worrying news in Victoria as well. And it will probably mean that this country opens up more sustainably a lot faster than it would have if we hadn't gone through this time at the moment. So, although it's not fun sitting here in my living room with the kids running around, I can see that there's light at the end of the tunnel.
Yeah, exactly. I think the number since this Sydney lockdown, it's seen a 51% weekly increase in vaccinations. And I think, like you said, Ben, we're actually going to need regular reminders about this, because once the population is sufficiently vaccinated, we're probably still going to need annual boosters or what have you.
Yeah.
And it's events of this kind which actually contribute to that and allow the economy to be opened up sustainably, as you say, so which is what we all want. But
yep.
And it's a good point. Let's go through some of these other corporate activities that have been going on. Woolworths split from Endeavour, demerger. So shareholders in Woolworths have got one share in Endeavour, trading around $6, 20.30 at the moment. We like the idea of demergers. We like the idea of this demerger. Small holdings looking to top up generally is my approach, Ben.
Absolutely. And I think, we've said this many times on, I think, our insights, demergers have an incredibly high success rate of creating shareholder value. And often the demerged company is the one that actually flourishes after moving on a life of its own. We know that Woolworths probably underinvested in Endeavour for a couple of years leading into this, because why would you pour too much money into a business you're about to say goodbye to? And we know that this Endeavour business owns some great assets. Again, a lot of the hotels in Sydney will be closed at the moment, so it's not going through a great time, although I'm sure Dan Murphy's is doing pretty well. You've got a great operator there, Bruce Matheson, probably one of the best operators in the pub business, who is also the major shareholder, something we always look for in businesses when we're investing.
Yeah, absolutely. A good one. So speak to us about that one. The Link. So finally, PEXA, their 41% owned property exchange, which is basically revolutionising conveyancing for those who aren't familiar with it, is now listed separately. And Link hasn't taken off. So Link looks really quite cheap, Ben, on the back of that.
Yeah. And bear in mind, Link had a takeover bid for the full company. It also had a takeover bid for the company ex-PEXA. There was a lot of debate. A lot of the analysts didn't believe the PEXA valuations. It was a bit of a shuffling of deck chairs amongst the three shareholders to get to a valuation. But the public market has actually ratified that valuation. PEXA is being valued at about $3.4 billion at the moment. Link is the major shareholder. It gives you a look-through valuation for the rest of the business, and it's trading on about half the EV to EBITDA that Computershare is currently trading on. So it looks very cheap. And, PEXA I still think is going to be an amazing business, but it's probably the cheaper entry point to PEXA is through Link as opposed to buying PEXA shares directly.
Yeah, that's right. On some things that will throw some money back into the market, Boral, the 7 groups increased and they're rising on that register now, Ben. I think, you might even see them get through 50% soon. But also, if you can give us some commentary on the big deal in the pharmacy space, Wesfarmers, who we know are always a pretty shrewd investor, making a bid for API, which is the owner of Priceline.
Yeah, it's another one of these. Wesfarmers has been, I guess, fairly cautious on the M&A front. You would call it more a bolt-on sort of acquisition for them, but it makes a lot of sense in terms of what they're doing. This is a company that's looked after its shareholders so well over so many years. And again, you think back to the demerger of Coles, the value that was created for shareholders through that was extraordinary fairly quickly. So that made sense. Soul Patts, not so much in the pharmacy space these days, but the takeover of Milton is going to propel it right up the ASX 100, and that was big news. Jess, you've followed that one for decades without showing your age.
Look, Soul Patts has been so over so long, and it was one of the first ones I looked at in my early years in this business. But we love it. We love it even more. It's going to become a big player. It's going to be the number 54 ranked stock by market cap after this Milton acquisition, which it was a pretty small company, profitable, very, very good management, but now it's actually become sizable as well. So it'd be even harder for people to ignore. And for anybody who thinks they're attached to the old view that it was a conservative and relatively passively run organisation, I think they have a major announcement at least weekly at the moment on average. And the turnover in their portfolios since Todd Barlow's become CEO has been impressive and value accretive for shareholders. So a terrific story. And you can also see that reflected in Brickworks, Ben, which is the cross-shareholding with Soul Patts has seen that get to a very substantial level, up around $24. So, but all in a very healthy market as we're seeing record highs hit most days in the last few weeks. And we're coming into reporting season in August. So to give a bit of a foreboding to people, we are in US reporting season now. We're seeing record highs on some of our favourite stocks there, Ben, Amazon, Alphabet, for example.
Yeah, it's been great, Jeremy. We've been talking about these businesses for some years now, and I think all five of the initial sort of little portfolio we put together are all trading at all-time highs. Amazon's been the recent star, just broken out, and that's really been fueled by the fact that I don't know if you remember, but Google took off when the two founders of Google stepped back, and a new CEO came in who looked at some of the things that Google was spending money on and said, this just doesn't make sense. And Google turned from an amazing business, but it started to become more focused on profits and, not burning cash on shooting satellites to the moon and all these sort of wilder sort of stuff it was up to. And I think just reading some of the commentary, there's this real feeling that Andy Jassy could do something similar at Amazon, where he could be much more earnings focused. And we know that Amazon could be wildly more profitable if it chose to be. And, I think the market, 37.50, I think Amazon's now hit, which is, it's almost doubled since we now first started buying it. It's been incredible. One I've really had my eye on recently has been Netflix, which has been quite quiet over the last year. And I think it's seen as one of the kind of the COVID winners that's been left behind with everyone chasing travel stocks and the reopening sort of trade. But their last quarterly, Jez, that $5 billion on-market buyback announced. First time they've started returning capital to their shareholders as opposed to raising. And that's because they've now created the backlog of content that they needed to sign people up. And it's now the spend going forward is going to be a lot easier for them. And 250 million subscribers globally, which they believe will double in the next 3 to 4 years. And, I still think $12 a month, they could charge quite a bit more and we'd all still be subscribers. So, it's where tech hits that tipping point, that the spend starts to drop, the revenue starts to accelerate and the profit just goes nuts. And you're not paying a big PE, for it by Australian standards at the moment for a pretty good quality business.
Yeah, with exceptional growth and that leverage that you look for in any business, really, don't you? So Netflix certainly one to be looking at too, I think, in that space. One of the original FANG stocks, but it hasn't taken off like the Amazon and the Google so much. Good news on Apple overnight too. They've increased their production numbers. They've told suppliers to gear up for 20% increase in the new models coming out and moving into the buy now, pay later space. So they're on the move too.
Yep, absolutely. And it's interesting. Like, these stocks were all out of favour for some time while that reopening trade was happening, but they've come roaring back. They're not overly expensive even after the runs that they've had. But it'll be great to get some updates from the businesses. The banks always kick off, and they're kicking off this week. But I think both the US reporting season is going to be very strong. Our reporting season, I think, is going to be extremely strong. But I think the market's going to be focusing a bit more on the outlook statements this time around, as opposed. We all know the numbers are going to be very good. But as things normalise, trying to get some feedback from CEOs as to what the next 12 months looks like.
And remember, we've been through a year or so, we've got virtually no guidance. So it will be important. And I think that's where the difference will be. And you'll see, I think, that old paradigm go back to being good guidance, we well rewarded, and doubtful guidance may be punished a bit. So just the market at these levels, that's typically the case. But we're still seeing pockets of value, and we're enthusiastic about what it means. We look at that resource sector as a big dividend sector, and dividends to return to where they were, in 19 and 18, really. So that'll be good for all of our investors and clients. So. All right, Ben, we'll back to work for you and me, and sign off on this July edition of Insights. And we're obviously hoping that we're back to normal and in the office for the August versions, which will be reporting season editions. And we wish everybody well.